Hello everybody. It's nice to see everyone here. This is something I've been wanting to talk about for a while, and I've been talking about it a lot on an individual basis, and whenever that happens, or I end up having a similar conversation multiple times, I know that for the 3 or 4 people I'm having the conversation with, I've got another 20 or 30 traders that probably have the same question. So we're going to talk today about trading multiple currencies inside of your account. And what I mean by this is that basically it means that you're going to be holding more than one position. You may be holding 3 positions, 4 positions, 5 positions. Let's talk about why someone would want to do that. So again, it says some traders will take multiple positions inside their trading account. Now, why would you do that? Well, here are some possible reasons. Multiple trades trigger at once. So you may have a couple trades around the same time trigger, and you want to trade all of them. Okay, that could explain a reason why you end up with 2 or 3 or 4 trades all going on at once. Okay, I can understand that. Next one, diversification. And I put a question mark after that because I've heard that explanation to me before. Diversification. Well, I don't want to put all my risk into one currency pair. I want to spread it out. I want to spread it out to maybe 5 or 6 different positions all working for me. That doesn't make any sense to me. We'll definitely cover this. Hedging. Hedging is something that actually does make sense. It's where you are taking one position and you currently want to change that into a different position. And we'll talk about hedging. But basically you could end up with 2 or 3 different trades in your account, and it's all based on hedging. It's all based on, okay, I want to protect myself from this one currency moving against me. So I'll put on another position over here that will basically make as much as I lose in the other position. That's the definition of hedging. You're not buying something or selling something to make a profit. You're buying or selling something to eliminate a loss or to control a loss. And the last one is ignorance. All right. That is the one that we are going to fix today. We're going to talk about yes, sometimes it is acceptable to have multiple accounts, but 99 times out of 100, it's ignorance. And when I finally sit down and talk to people about what they're doing, they say, oh, okay, yeah, that's pretty silly. So this is what I want to spend my time on with you. And please excuse me, this is one of those soapbox issues for me. This is one of the issues that get me all riled up about trading and traders. And you'll see when I get through this, you'll see what I mean, and how being in my position and looking over people's shoulders sometimes is very frustrating to see this, because it just tells me that they don't understand. So let's really get into this ignorance part, and let's really fix it for all of our traders. Let's get this out early on to where our traders can just get into trading and they don't have to do these really silly things. So the big thing about ignorance is it creates a lot of overlap, and overlap is just an increase in costs and fees. And I'm going to go ahead and explain that right now. Now we're going to all go back to, I'm going to call this 4th or 5th grade math. I can't remember. My kids are older now, so I can't remember when they learned the transitive theory of mathematics. And I know you guys, some of you are like, oh no, math? This is a pretty simple one. If A equals B and B equals C, then A equals C. Raise your hand if you remember the transitive theory of mathematics. Okay, good. It's not that hard. If A equals B and B equals C, then A equals C. So how in the world does that apply to currencies? How in the world does that apply to currency trading? Well, let's talk about it. Let's give an example here. So here we have an example. Transitive theory of mathematics. If A equals B and B equals C, then A equals C. So let's say that you look inside a trader's account and you see that they are long, and again, I'm just going to put a number. Let's say they're long $100,000, 100K worth of euro, US dollar. Great. So what does that mean? It means they're long 100,000 euros and short $100,000. That's what it means. These are the positions they're holding. Technically, they're long 100,000 euros and they're short $100,000. That's what this position is. Now they're holding the same amount of long US dollar Japanese yen. So over here, they're holding 100,000 long of dollars, and they're holding 100,000 short of yen. Okay. If A equals B and B equals C, then A equals C. So if this trader is long euro dollar, so long 100,000 euros, short $100,000, and they have another position where they're long $100,000 and short 100,000 yen, what position are they really in? This trader, cross out this, this trader is simply in euro yen. Look at that. This is the position they're in. It's euro yen. Now I have to ask the question, why didn't they just enter euro yen? Why did they spend 2 transaction costs, 2 spreads, now they're going to handle 2 positions? What was the reason? Well, let's go back to the possible reasons. The possible reasons to trade multiple currencies like this is multiple trades trigger at once? No. It's the same. It doesn't make any sense. Diversification? You're not diversified in any sort of way. Hedging? This person isn't hedging. The only thing that's left is ignorance. Ignorance. There is no reason at all to make a trade like that. All it's doing is it's causing you to have multiple transaction costs, multiple spreads, multiple positions, and nothing is happening. Nothing is happening. So, I'm going to go into something a little bit deeper, and I want to really give you some perspective. I actually went in and took these numbers from a trader's account. And again, this has been a pet peeve of mine for a little bit. I've seen this more and more with our newer traders, and I've decided I'm definitely want to put a stop to it. Because take a look at this portfolio. I got a trader that's long, or sorry, that's short 20,000 euro US dollar. They're long 1,000, 10,000. Oops, sorry. I was supposed to be fixed. I don't know how that got erased, but all right. Sorry about that. There we go. Now it's fixed. Okay, so they're long. They're short 20,000 euro US dollar. They're long 20,000 euro pound. They're short 20,000 dollar yen, and they're long, they're short 18,000 pound CAD. Now this trader is like, wow, I'm awesome, I'm good. I went short euro dollar over here. I went long euro pound over here. And look at this, I took short in dollar yen, and then I took a short in pound CAD. Man, I am awesome. Look how awesome I am. I know what I'm doing. All these trades are awesome. Wait a second. There is incredible overlap in these positions. This person put on 4 different trades. 4 different trades with 4 different position management, but understand that there's a whole lot of overlap in here. There's a whole lot of, if this one goes up, this one's going to go down, and you're not going to make any sort of money whatsoever. So what I want to do is I want to take this sample portfolio and let's break it down. Let's break it down and see what position is this trader really in. What position are they in? They made all these trades, they got all these costs, they're doing all this work, they've got all this management. I'm guessing they're not in 4 positions. I'm guessing they're in 2. Let's take a look at it. All right. So here we have, let's just go down the list. Let's go ahead and start off with Euro. Okay, so let's identify their positions. In this first one, they're short 20,000 euros. So they are short 20,000 euro and they're long $20,000. Great. All right, let's take the next position. In this position, they're long euro pound. So over here, they're long 20,000 and they're short 20,000 in pound. Sorry, this is supposed to be plus on the pound down here. All right. So next one, they are short $20,000 yen. So they're short $20,000. They're long 20,000 yen. And over here, pound CAD, they're long 18,000 worth. Now again, I'm not doing the math correctly. This is really, if you want to do the math correctly, you go with market value. I'm not going to do that. We're just going to go with position size. I'm just doing this to show you the concept. They're long 18,000 a pound, and they're short 18,000 of CAD. So here's this trader taking this position here, this position here, this position here, this position here. And let's see what they're in. Well, are they in any euro whatsoever? No. They have no euro exposure whatsoever. Do they have any dollar exposure? No. They have no dollar exposure whatsoever. Do they have pound exposure? Yes. They're long 2K of the pound, and they are actually long 20K of the yen. So this entire portfolio, let me tell you what it is. It's going to be long CAD yen. Sorry, it's going to be short CAD yen. Yeah, let's throw a minus up there. And again, anyway, but it's going to be 2 positions. It's going to be 18K of CAD yen, and it's going to be 2K of pound yen. Look at that. This trader thought they had all this exposure. Wow, I've got 80,000. I've got 80,000. I almost have a whole lot in the market. Wow, look how smart I am. No, you don't. You have 20K of exposure in the market. That's it. As you can see, this is an incredibly ineffective way to trade. But I see it, especially in our newer traders. It doesn't make any sense. It's just ignorance. If this is something that you've been doing or know someone that's been doing, educate them. It's complete ignorance. This is the real position. Now, what they did is they took their portfolio and they have 4 transactions, 4 spreads. They've got to manage 4 positions. It doesn't make any sense. It makes no sense. They ended up with 18,000 of CAD yen and 2K of pound yen. That's it. That's it. So hopefully everyone sees and understands that just putting on multiple currencies inside your trading account. Oh, this one triggered here. I got long euro pound, and then over here euro dollar went short. I'm going to short that, and I'm going to do this and this. All you're doing is creating more costs. There's a tremendous amount of redundancy, tremendous amount of wasted energy, and a tremendous amount of wasted cost. It doesn't make any sense. So, hopefully, this has brought you to the point where you understand that you don't want to do this. It doesn't make any sense. Just take CAD yen long for 18K and pound yen. It's a much easier way to do it. Let's talk about when it does make sense. Let's talk about when it does make sense. When should you trade multiple currencies? Taking multiple non-correlated trades. All right, let's go quickly through what that means. So taking multiple non-correlated trades. So let's say that someone is long dollar CAD. All right, someone is long dollar CAD. All right, and they want to take another position. Well, if they take another position in anything dollar or CAD, isn't that just incredibly redundant? I mean, if they take a position in pound CAD, all they're doing is canceling out CAD, and now they're just in pound dollar. They need to take a non-correlated trade, something that doesn't have any correlation. This may be let me use the example of dollar Aussie. Yeah, I gotta mix it. Okay, let's say somebody uses Aussie dollar. Now we all know that Aussie and Kiwi are fairly highly correlated, so they're long Aussie dollar, and then they go short Kiwi dollar. They're going to just simply end up in Aussie Kiwi. That's all they did, is they ended up in Aussie Kiwi, and we know the Aussie Kiwi are correlated currencies. It doesn't make any sense. It doesn't make any sense to do a trade like this. If someone's in Aussie dollar, an uncorrelated trade would be something like Euro Swiss franc. Euro Swiss franc has hardly any correlation whatsoever. The euro doesn't have any correlation hardly with Aussie or dollar. Franc, same thing. This is an uncorrelated trade. So if these two trades triggered, take them. They're uncorrelated trades. But if these two trades triggered, Aussie dollar long and Kiwi dollar short, it doesn't make any sense. It doesn't make any sense at all to take that second trade. It's a redundant trade. You really should just get out of Aussie dollar and play Aussie Kiwi directly. It's going to be a lot easier for management's sake. It'll be the same in transaction costs. Now you'll actually save one. You'll save one transaction cost on the way out. It doesn't make any sense. So again, taking multiple non-correlated trades. That's one of the times where I would say, you know what? It does make sense to have multiple trades in your account. The other two times are the ones I actually wanted to spend the most amount of time on. Pyramiding. We actually used this strategy. Last night. We were looking for dollar reversals, and the dollar reversed. The first position we took was Kiwi dollar. The RBNZ came out with very good news. The Kiwi popped. We took a position. Once we moved the stop up, we said, hey, let's pyramid another position. We took a position in Aussie dollar after that. So at this point, we are now in Kiwi dollar long and Aussie dollar long. So we're basically double short the dollar. We're double short the dollar. And then you could even take a third position. Once you're able to move up your stop to break even on this one, take another one. Take euro dollar. So basically now you're 3 times short the dollar, but your stops on the first two are break even. Now, this is not something that at least I do often, because what you're really doing is, remember, your job is to identify the number 1 currency and play it against the number 8 currency. And that's what we did here with Kiwi dollar. That's what we did here with Kiwi dollar. You can see that we probably would have been better off. If you take a look at times here, time we got into, this right here was the time that we got into our second position. You can see they both did well, but the Kiwi still went up more. We would have been better off pyramiding the first position and just legging in and buying more. So the way this really works is if you take your first position, let's say we took our first position in something like pound dollar, and it was working but not all that good, and we saw other currencies working more. Once we went to break even on our first position, then we could take a second position in something that was showing much more relative strength. So much more relative strength. You know, maybe then we go and play the next one, pound or Kiwi Aussie, or sorry, Kiwi dollar or Aussie dollar. So this idea of pyramiding, where you're still, it's hopefully you understand it's not a non-correlated position. It's almost the same position. We're still short dollar. We're just adding in extra legs to it. Another time that I've used this, and Richard brings this up, there's some times where I am really sold on one currency. And let's take last night. Let's take dollar short. You know what? Dollar short was a play. But there is some times where I look at charts and I say, I don't know what to play against it. I don't know what to play against it. I know I want to be short dollar, but I don't know if the Aussie is going to be the strongest, the Euro is going to be the strongest, or if the pound is going to be the strongest. So what I could do is, if I wanted to take a $100,000 position, I could split it up into three. I could split it up into three, and I could take 33K of pound dollar. I could take 33K of Aussie dollar. So what this does is that the real play here is I want to be short the dollar. I just don't know which one of these is going to be the best. And by spreading it out, I'm probably, if my premise is correct, I'm going to be right on at least 2 out of 3. Because I know all of you have had the situation, and again, give me a raise your hand. Raise your hand if you've had the situation where you called one side of the trade perfectly correctly. You called yen short, but you went long CAD, and CAD ended up being the crappiest thing to go long at that moment. Everything else went up against the yen, but you picked CAD. That's a frustrating trade. I've been there before many times. So this little strategy, sometimes if you're not totally sure, boy, do I want to do CAD or do I want to do Aussie? Split it up. Hey, I was going to do a one-lot trade anyway. Let me do half over here, half over here. It's still the same trade. You're still short the dollar, which is really what you wanted. You just split it up into different halves. So again, this is something I do every now and then, and it's when I'm convinced on one side of the trade, but I'm not convinced on the other side of the trade. I'll break it up into multiple trades just to make sure I'm in some of the right stuff. So again, this is a great example of having multiple trades in your account that aren't all crossed up against each other, where again everything gets cross-reduced down to no position, like we just looked at in the prior portfolio. This makes some sense. Alright, so let's take a look at hedging. And again, it's going to be a fairly quick rundown. We actually have a whole session on Forex hedging. So I'm just going to do a quick study of that. That session is in the advanced concepts section of the website. Let's say that I'm long US dollar yen. So obviously I think dollar is going to be strong, and I think the yen is going to be weak. And let's say that during the trade, the dollar is actually doing very well. Let's say the dollar is doing well. But that darn yen is stronger than I thought. And just like I talked about, how you pick one side correctly, but you pick the other side of the trade incorrectly, where you should have been, let's say you should have been in, let's say the CAD is showing the relative weakness. So you take this position in dollar yen, but that yen is holding up too well, and you say, you know what, I really want to be in dollar CAD. If you sell the same amount of CAD yen, you can actually change your trade into dollar CAD. Now, hopefully you're asking yourself the question, well, why wouldn't you just sell dollar yen and go to CAD yen? Or sorry, why don't we just sell dollar yen and go to US dollar CAD? You should if you think that's where you want to be. But hedging is a temporary freeze or a halt of your current trade. Your premise is that you want to stay long dollar yen. Let's say that your premise is, hey, I want to stay dollar yen for the next 2 weeks. And let's say somewhere during that 2 weeks, the yen starts showing some relative strength. You simply want to change your trade for a small period of time. You don't want to get out of your original position because you still want to hold that position after the hedge is taken off. After the yen stops showing strength, you want to go back to dollar yen. So during the trade, you can simply sell a different currency. And again, this is going to be, again, the transitive property. You're basically taking yen out of the equation. You're short yen over here, you're long yen over here. You've just completely wiped yen out of the equation. And for this period of time, you're actually in dollar CAD. You're actually in dollar CAD, and you're going to get the same return that dollar CAD gets during that time. And then once that trade is done, and you want to go back to your dollar yen trade, you simply get out of your CAD yen play, and you're now back into dollar yen. Now, me personally, I'm not a hedger. And I've used this strategy before, and let me tell you why I'm not a hedger now, even though I've tried this strategy before. Most of the time, a hedge is simply a way to avoid taking a loss, or to try. Most of the time, a hedge is just a way to say, oh, I don't want to get stopped out. Let me hedge it out. It's not going for you. I found out it's much better just to get out. Just to get out of the trade, pull your money off, and sit it out. We talk about that in the hedging session that we do quite a bit, quite in depth. So again, this is an example of where I could look at someone's account and say, okay, you know what? I understand why they have this multiple position. They had this position, they want to hold dollar yen, but for the short term, dollar yen showing some strength, so they've hedged it out, and then they're going to go back to dollar yen sometime in the future. That would make some sense. But everything outside of this, everything outside of, let's go back to the three things. Everything outside of these three items, it's most likely someone just not knowing what they're doing. Someone just not knowing what they're doing. Taking, oh, I'm going to take this trade a little, take this trade a little, this trade a little. They're just ignorant. They just don't know that everything is just cross-reducing each other, and they're ending up in very small positions and spending a whole lot of money in transaction costs. All right. Richard asked a question, how would you get out of this example? Well, if you take a look at it, you're still, when you're in two positions, you're in dollar yen, and then you got in CAD yen. You still are in two positions. So to get totally out of everything, you've got to close both of those positions. So if you wanted to get out all at once, you'd sell dollar yen, and you'd buy back, and you'd buy CAD yen, and you'd be closed out. But if you just close out one side, and again, you could actually do it the other way. You could start out with dollar yen, hedge with CAD yen, and then decide, wow, you know what, maybe I'm wrong in my original one. CAD yen actually looks really good to the short side. You could actually exit out of your dollar yen and switch over all the way to CAD yen. Again, it's not something I like to do. Just switch it out. But to exit that, you're going to want to just get out of everything. Just close the positions out. All right. So again, this wasn't going to be a super long session. I want everyone to understand. Trading multiple currencies. It makes no sense at all to just have such a basket. And there's so many things going on. I mean, you're trying to do position management on 5 different trades all at once. And it's so stupid because all you have is euro yen in the end. But you're wasting all this energy chasing this one down and this one down, and now you've got 5 executions to get right, and who knows how you end up. It's quite silly. It's quite silly. So once you understand this concept, it's going to make you really kind of think differently about, okay, well, why am I taking this position? Why am I taking the second position? This doesn't make any sense. This is just going to change me into, euro yen, and I don't want to be in euro yen, so I can't take this position. And as I said, it just wastes money. It wastes money, it wastes energy. They're all redundant positions. In that example we showed you, it boiled down to 20K, 18K in CAD yen and 2K in pound yen. And it just didn't make any sense at all. A good way to use it for is pyramiding. I like using this for pyramiding. Usually when we do legging in and pyramiding, it's all on the same currency pair, but it doesn't have to be. If you're long in Aussie dollar and you want to add a second position, but you think that Kiwi's actually a little bit stronger than Aussie, add the Kiwi dollar. You're still short dollar. That hasn't changed. You're just doubling up on your short dollar trade. You're just using a different currency to go long against it for the second one. So pyramiding is just a great way to end up with multiple positions. Then the last one, only hedge if you want to. Again, we have a session on hedging. I'm not a hedger, as I said. Hedging to me is a way to try to not admit you're wrong at the moment and try to turn your trade around to where you're smart and successful in the future because you don't want to deal with the pain of it today. I found I get myself in a deeper hole when I try to hedge than if I just would have got out, pulled my money off, and sat back and waited for another opportunity. It's really a dangerous trap to get trapped in. All right. Mike has a question. For an example, yesterday the long Kiwi dollar and the long Aussie dollar, okay, because the Kiwi and the Aussie are correlated. The long ones don't have to be correlated. If you remember, we really talked about we want to get short dollar, and that was we send out an alert. We said, hey, we're looking for reversals against the dollar. We're looking for short dollar plays. So the first position we took was Kiwi dollar. Now Kiwi really shot up. It really shot up off the RBA announcement. And at the time, it was actually quite overextended. Kiwi was overextended, where things like the Aussie and other currencies, they weren't overextended, which is why we decided to go with the Aussie on the second one. If the Kiwi wasn't so overextended, it would have made more sense to double up on the Kiwi. But the real play, and hopefully you understand, the real play was just short dollar. We wanted to be short dollar. We wanted to find currencies that were showing relative strength. Now, just to completely finish this story, I personally made both of these trades, and I was going to make a third trade. I was going to make pound dollar. That was going to be my third leg. I was going to throw on pound dollar. Here's the problem. The pound never got strong. The pound never strengthened and broke out of my levels. My full intention was to have 3 levels in this trade, to have these 3 currencies. The third one just never triggered. It never triggered because the pound just never got strong. And so, ended up with 2. So not bad. Made a 150 pips between the 2. So never can complain about that. I think it's more than that. No, sorry, it was 200. Yeah, 200 pips between the two. All right, great session, everyone. Hopefully this helps clear everything else. And thanks for joining me. Bye, everyone.